Welcome to The Explainer. Today, we're jumping right into a deeply fascinating perspective, the worldview of precious metal advocates and how they size up systemic global financial vulnerabilities. We're going to look at the global economy through a very specific alternative lens, one that seriously questions the very foundation of the fiat currencies you and I use every single day.
Okay, here's our roadmap for today. We'll hit the great pricing illusion, central banks and sovereign debt, the fragile credit system, derivatives, what they call the hidden gorilla, and finally, precious metals as insurance. Let's get into it.
First up, the great pricing illusion and flipping the perspective. So to really grasp this viewpoint, we've got to look beneath the surface of daily market volatility. The standard view? It tells us gold is an investment that bounces around, maybe rising from $300 up to $4,000. But the alternative view entirely flips the script. It suggests the metals are actually static. They aren't doing anything. Instead, it's the fiat currencies that are crashing against them, thanks to inflation and constantly expanding money supplies. So in this view, it's not gold going up. It's actually the US dollar falling from being worth 1/30th of an ounce of gold down to just 1/4000th of an ounce. Wild, right?
Advocates point to this staggering number, 93%. That represents the absolute crash of the dollar's purchasing power against real money over the last 25 years. It kind of forces you to ask, why do people buy precious metals in the first place? Is it to make a quick profit in paper dollars? Or is it because they're worried about the long-term meltdown of fiat currency?
Which brings us to our next point. Section 2, Central Banks and Sovereign Debt, or the shaky foundation.
See, if the currency is losing value, we absolutely have to look at the institutions printing it. Analysts highlight a massive, frankly mind-boggling figure here. The U.S. Treasury is now paying a record-breaking $1.5 trillion just in interest. Just the interest. That makes debt service one of the government's absolute largest expenses, outpacing almost everything else, even defense spending. And with borrowing costs rising, that number is literally only going to grow.
Now look at this fascinating contrast between the big players in the global system. On one hand, you have the Federal Reserve sitting on negative equity. Their bond portfolio is cratering by hundreds of billions of dollars because of rising interest rates. Yet this technically insolvent entity is issuing the world's primary reserve currency. On the other hand, global central banks see this shaky foundation, and their reaction? They are voraciously buying physical gold. The source poses a great hypothetical here. Imagine a country holding 100% of its central bank reserves in dollars. If the dollar melts down, what happens? Total chaos.
And this desperate search for a real, tangible foundation, you can see it in the ongoing discussions by the BRICS nations too. They're actively exploring alternative payment systems to bypass the dollar, utilizing a proposed commodity basket that's heavily weighted. We're talking 20 to 40% in gold, right alongside silver and oil.
Moving deeper, we hit Section 3, the fragile credit system and the chain reaction it can cause. So here we're examining the modern economy's absolute reliance on uninterrupted credit markets. It's perfectly illustrated by this loaf of bread analogy. Think about it. You literally cannot get a simple loaf of bread to your grocery store shelf without at least a dozen different uses of credit. The farmer needs credit for seeds, the logistics company needs it for trucks and fuel, the grocery store needs it for inventory. The whole shebang is an interconnected chain. If just one of those dozens of links snaps, well, there's no bread.
To emphasize just how fragile this is, the sources point to recent real-world disruptions. Take Japan, for instance. They recently had a 24-hour credit card outage. Now ask yourself, what would your world look like if that went on for 3, 4, or 5 days? What if bank credit completely vanished for a week? We are entirely 100% dependent on this functioning electronic infrastructure.
And that leads us to Section 4, Derivatives, the hidden gorilla.
This brings us to what the source calls the gorilla in the room. We're talking about massive, unseen risks just lurking in the shadows of the global financial system. The source leverages this famous warning from Warren Buffett, who explicitly called derivatives financial weapons of mass destruction. People are out there making bets on everything, literally from the weather to water temperatures, and sure, there's always a counterparty to take that bet. But the sheer scale of these interconnected obligations is completely staggering.
The scale here is, honestly, it's hard to fathom. Analysts estimate that outstanding derivatives are actually 4 to 6 times the total amount of all physical and financial assets on planet Earth. Let that sink in for a second. The paper bets on the assets are vastly, vastly larger than the actual assets themselves.
And right here is the true systemic risk. Counterparty risk.
It's like a massive global game of musical chairs. When the music stops, the system breaks. The winner of the bet technically wins, but they actually lose because the losing party doesn't have the cash to pay up. If the loser defaults, nobody gets paid. And because everything feeds right back into that fragile credit system we just talked about, a failure here threatens the entire global economy.
Finally, we reach the bottom of the iceberg. Section 5, Precious Metals as Insurance.
This brings everything together to explain why these advocates view physical metals as the ultimate financial insurance. First off, they challenge a very common mainstream narrative, the myth that when interest rates go up, gold and silver have to go down. But they point to historical reality to disprove this. Look at the 1970s. Interest rates rose for the entire decade. Yet, during that exact same period of elevated inflation, gold skyrocketed from $35 an ounce to over $850.
Now, you might be thinking, well, what about the 1980s, when Paul Volcker jacked up rates and crushed inflation? Actually, the analysts argue that context is everything here. Back in 1980, global balance sheets were relatively healthy. They could handle those rate hikes. Today, not so much. The U.S. Treasury has $10 to $11 trillion of debt that has to be refinanced in the next 12 months at much higher rates. Commercial real estate ventures that borrowed at 3% are suddenly staring down 6 or 7%. Analysts argue today's massive debt bubble simply cannot survive higher borrowing costs without blowing up corporate and sovereign balance sheets.
So from this perspective, the case for physical metals is built on these core pillars. It's not about chasing rapid fiat profits. It's about holding capital safely outside of an insolvent system. It provides financial insurance against inflation, protects against government debt expansion, and completely eliminates your reliance on vulnerable banks. Most importantly, holding physical metal in your hand carries zero default risk. There is literally no counterparty who can fail to pay you. Advocates also warn of the great taking of paper assets during a crisis, making physical possession the absolute key.
Ultimately, this explainer challenges us to look at our own portfolios through an entirely different lens. It asks us to consider if fiat currencies keep losing purchasing power, and if this highly leveraged credit system falters, where does that leave you? When the systemic music stops, will your wealth rely on vulnerable credit chains or serve as true financial insurance? Thanks for joining me on this deep dive, and keep questioning the systems around you.